been a pretty stellar week. We're just going straight up. No no testing mid vamp even. Everything's looking extremely bullish. It's pretty nuts. I am starting to get a little worried here though that a pullback is coming. Um, no real science behind it, just kind of feeling it in my balls. But I think this risk on regime might be coming to a close, and I think that's something that we should be talking about in this podcast. And
Yeah,
the thing is with these pivot points, though, that makes it difficult is the system tends to be a leading indicator, and it's hard to find justifications for it in the moment until it starts to fluctuate through the economy and affect the market like the system has been seeing. And so that's when you really start to see the justifications for it. Um, but right now, it's like I'm still bullish. Like I feel like it shouldn't be risk off soon, but we got to listen to our system. We're not there yet, but it, it it is coming close.
yeah. So this is something important, I think, to touch on. Look what you said there. We're not there yet. Like we've seen regimes. Let me pull up the regime map. So take a look here. You could see what the growth index looks like, and the inflation index. And obviously, if they're both bullish, it's risk on. If growth is bearish, it is risk off or slowdown. So that's pretty simple that way, right? Not very complicated. Now, we have seen periods where growth gets a little spooky and recovers. And a good example is actually just in August. Growth impulses, they fell below the trend level where they would become a problem, odds becoming problematically or odds rising and becoming problematic that we are going to switch into a bearish trend. And we didn't. We recovered and we rallied. Now, I just have a feeling that things are a little bit different this time where we are right now. And maybe we don't recover right away, leaving at least a window for risk off or slow down. And obviously, none of this means we're going to short the market. None of this means it's going to, we're going to go outright and or short specific names. We don't short in our models. Our strategy doesn't involve shorting, tactically long. And I think where we are right now is actually at a very interesting juncture that can lead to either one of two things. I do have a feeling we're going to leave risk on. It's again, feelings, we don't act on feelings, we don't front run the models. We haven't made any position changes. We're still max long and we're watching the P&L pretty much rise almost every day. We were at all-time highs yesterday. So, obviously things are good right now, but we are seeing some weakness in impulses, and that's somewhat concerning, right? It's not shouldn't, get you all rattled, but I do think that the weakness we've been seeing in impulses is at least persistent enough to take us out of risk on and the way that they've been moving. Let's go back to August earlier this year. It was a pretty rapid move down. Even in July, rapid move down, recovery, rapid move down, recovery. And like we actually spoke about this a couple weeks ago in a ledger note that impulses are just they were just very hot, very high, very strong, right? And they almost felt like they didn't have anywhere to go but lower. And funny enough, as impulses faded from like September 14th down to where we are today in the Nasdaq, right? September 14th was here. The market obviously has gone higher. So you can't just look at this and say, okay, impulses are rolling over. It's bearish. I think the key here is to get a structural change in the direction of impulses, which will give you, in simple terms, it would be having the direction of impulses change enough to shift the trend. I think that's what the markets really care about. Them moving up and down in this range, chopping around is not a problem. And when we came out and wrote about how impulses could be weaker in the coming weeks, almost a month ago now, I think we were obviously long the entire time. So it wasn't something where we're like, oh, it's time to take risk off the table. Like we stayed positioned because what matters is the signals, not our feelings. Even though we think growth impulses were going to get weaker, the market's still up, and that there's a reason for respecting the signals. Because if we were to get emotional, we'd have taken ourselves out of a good leg of the rally over the last 30 days. So where that leaves us now, I think, is impulses have gone down consistently to the point where, like, I think it'll be a bit harder for them to reverse. I think they have a bit in a weird way, they have more momentum than they did earlier, or in the middle of the summer. So I think risk on is probably going to come to an end here. It may not be permanent, and I think this is the whole point of me explaining this is the scenario here, the outcome, right? So risk on probably comes off the table. Impulses have fallen. There's a possibility where impulses can rebound now. Things can firm up at some point. So these are the two scenarios I think are most likely. Either impulses are gonna break down and materially shift trend and fall a lot into the end of the year, right? And you're gonna get a year end sell off in risk assets, or you're gonna get this dampened environment of just weaker general growth impulses, which will lead to not a risk off environment, but a slowdown environment. And in terms of risk in the market, slowdown is significantly better than risk off. Like you could take equity exposure in slowdown and still make good money, where risk off is just not, it's just a pretty ugly regime all around. Bonds, gold, probably the only things that do work well. Like Bitcoin can work well in a slowdown. Certain sectors will outperform in a slowdown. So equities are still somewhat of a long. But in risk off, you don't really want to be long equities. You kind of want to be long the defensives, no Bitcoin, something, stuff like that. So those are the two options I see. I think most likely, if I had to guess what would happen is I'm kind of torn. I think the odds of a slowdown are probably higher than risk off, but I do think we're going to depart risk on at some point, probably in the next week. And we're going to wait to reposition, but I think that's what's going to happen.
Yeah. And uh, a lot of what the outcome is going to be also depends on how inflation expectations change from here. Like, are inflation expectations also going to go bearish with the growth index going bearish? Because that would be a full blown risk off, where that would be very good for bonds. That would possibly be very good for gold. I don't know. Gold's already ran quite a bit. So it might not be as good for gold as it is for bonds. But that would be really like a full blown growth scare where growth is down, inflation is down because growth is dropping so much. I think I would rather have that though than stagflation, where we have growth just getting completely decimated and inflation starts to run hot again, like we saw in 2022. That would be a terrible scenario.
Yeah. So let's see. Let's take a look at GDP now quickly here. So this is what I think we're going to talk about here in terms of growth, and it'll make sense in a second, but obviously this model is not being updated. We're not even getting economic data for the most part given the government shutdown in the US right now. And this is where I think things get kind of interesting. So we were pretty vocal at the end of last year. So in Q4 of last year, literally Christmas Eve, we sold all risk assets and we were like, Q1's going to be a shit quarter. And it was. And we were slowdown slash risk off that entire, pretty much the entire time. The system signal was taking risk off, was out of risk or taking risk out of the portfolio. That's what happened. Right. And I think that if we look at growth at that time, we actually saw GDP GDP expectations roll over at the end of Q4 in early Q1, then out into obviously the tariff impacts of Liberation Day. Now, I think that we can take a step back and look at where we are right now, right? Look at GDP now. GDP now is at 3.8%. We're almost at 4 at one point. Economy is essentially operating, but reporting is closed. So this should be updated. It's not. So we'll see what happens when the data pipelines open up again, where this goes. The call here is not a recession. I want to make this clear. Whenever we say we're leaving risk on, we do not make recession calls. It's nonsense. Recessions happen in risk off. So if we're in a risk off position or a risk off regime, and we're positioned for risk off, odds are higher that recession can happen, which means we would be positioned for a recession, but we don't actively look and aim for recession forecasting. That's nonsense, right? No money, there's no money there. You're playing the Michael Berry game. You basically short the rally all the way to the moon. You don't want to do that. So for us, when we look at this on growth and a growth perspective, GDP now is 3.8%. Impulses are rolling over on the growth index. To say that like growth is going to material, this is we're playing the semi bear case here, by the way. If GDP now is at 3.8%, to say that what's GDP next quarter going to be? 3.8%, 4%, right? I mean, well, where are we going to go with GDP into the end of the year? Like, how much better is our GDP numbers going to get? And this is how you have to look at the market, right? Because if you just say, oh, this quarter's GDP is good, and then like next quarter is, 2%, if that is below market expectations, the market's going to sell off, even though it's a good general number, right? So what I'm saying here is we saw a nice recovery in GDP, and a good way to look at this is just look at growth, right? So let's look at GDP here, last 3 years. So we saw this nice rapid recovery from the Q1 weakness, right? So Q4, end of Q4, we go risk off, terrible Q1. Q2 is bouncing back. And we're basically long at the end of Q2, roughly, we're long risk assets again. And now we're seeing like GDP almost stall out to the point where like, okay, how much better is it going to get? And this is where you have to say like, be reasonable. Like, are we going to get 4 or 5% GDP? Are they going to fiscally run it hot, as they say, or is there going to be some exhaustion that happens here? And I think that the way growth impulses are moving, there's at least a perception that maybe there's a pause in the growth agenda. And that doesn't mean it's a recession. It just means like we had a nice hot quarter of growth, which was basically rebound and ramp post Liberation Day. This quarter looks to be strong. We'll see how that ends up. But any weakness into the end of the year, I think the market's almost pricing in some sort of like, the market's almost pricing in what seems to be perfection. So we just want to be cautious is all. If we get a risk off signal, we want to make sure we navigate it properly. But we're not sitting here calling for a recession. Remember, GDP now going to 2% is probably not good for risk assets, but it's not recessionary. So just understand the idea here. We're not saying that all assets are going to go to zero. Bitcoin's going to go to 50K. That's not what we're saying. We're just saying, look, the odds to leverage long risk assets fall significantly when you're not in a risk on regime. That's the play. So as long as you're in risk on, we're leveraged long. We have been, we will remain so until we pivot. And another like simple way to look at this is now that you're in a risk on regime, maybe you're positioned like we were. So we're long QQQ with leverage since like the 550s. Okay. So we're deep in the money on our longs. We're long Bitcoin as well. We're deep in the money, right? The way you can play this is if we do get a risk off pivot, and this is a discretionary approach, we do not do things like this, but here's a good example of what you could do. You could say, okay, I have a lot of profits here. I don't want to part with my risk on positions right away because perhaps maybe the system's getting a little too soft and it rebounds. We're in a slowdown, then we're back into risk on. And what I mean by that is simply this. The way the system operates is we go from risk on to risk off to slow down to risk on, risk off, slow down. It's a circular, call it the circle of growth, right? The life of growth. We go from risk on, slow down, risk on, risk off, and then we emerge from a risk off through the slowdown, and then we go back to risk on. Now it sounds counterintuitive, right? Like why is slow down after risk off? It's just how it's the best way we can quantify this. Without it doesn't logically makes sense how why slowdown would happen after a risk off environment. It's just how the
Well, it's
regimes come together.
it's also usually because risk comes fast and the market starts to front run it and panics. So like usually, like the saying, like you have the staircase up and the elevator down. So usually you
That's a
get
good
the
way to put
full
it. Yeah.
blown risk off initially, and then you get the slowdown as the market builds up confidence again and starts to build back up.
Yeah, or it overprices things initially with shock factor and then recalibrates and says, okay, it's bad, but it's not as bad, right? And that's the kind of life cycle of growth at Market Radar. That's how it works. So that being said, let's go back to the Nasdaq. You're a lot. Let's just say you're like us. You're long Nasdaq with leverage. You're long Bitcoin with leverage. Well, you have two plays here. If we get a pivot, well, the first play is you position for slowdown, risk off wherever we are at, which is to be expected, right? The second thing is you're above mid vamp on both of these. If we get a risk pivot and you're still above mid vamp, you can use the mid vamp as a trail. So here's an example. We're long Nasdaq, 3 times leverage, like I said. And let's just say we were to get a risk off pivot tomorrow, Friday, meaning Tuesday when the market's open, we have to readjust. Well, I know that as long as we're above mid vamp, we are going to go up. The base case is going to be higher. We have we have a very fat cushion from a low cost basis from our leverage longs. You can use mid vamp as a stop in this environment, where as long as we're above mid vamp, you just ride the wave up. Like let's just say market ignores growth impulses or our system just market doesn't move, right? It happens. Like you just saw growth impulses take a nosedive, market move higher. Well, you can put a stop in place, ride equities up until they break, and if equities start reacting to those negative growth impulses, boom, you're stopped out and you're aligned to the risk regime. So same thing with Bitcoin. Like Bitcoin actually held mid vamp today. It flushed earlier today, held mid vamp and retraced. So as long as you're above mid vamp on Bitcoin, same thing applies. Look, odds are that this can continue higher. So use this as a stop, right? Like be strategic if you want to kind of like maximize any extra returns that would come from risk on assets in a scenario where, like I said earlier, maybe we print risk off quickly and then go back to slowdown. In that case, Bitcoin becomes a long again in slowdown. So if the market initially gets a little spooked and then recalibrates, Bitcoin will go from being not long or not buyable to buyable again in slowdown. So that's like how you want to be positioned for this. You don't want to be like you know, thrown off guard when you see these things when you see the regimes and models move, but understand that like if we do get risk off and you do lose mid vamp and this Bitcoin starts puking, like that's to be expected if we're in risk off. When we leave risk on, we go to risk off. We do not leave risk off. We stay in risk off, and crypto starts puking. It's to be expected, right? So that's why using mid vamp, if you want to like try and squeeze out the juice, is fine, but respect your own stops. Don't start playing games with yourself if that's what you're going to do.
Yeah. I mean,
All in
like
all, though,
historically, most risk off triggers preceded a market crash. Like it works most of the time. So
yeah, yeah,
yeah, just got to be cautious. Got to keep tight stops. If you want to try to finesse it a little bit, squeeze out a little more juice, you really got to be on top of your stops and not let emotions get in the way.
yeah. Because at the end of the day, like I wanna I wanna simplify this in the most straightforward terms. This what you're seeing with the growth index is a warning sign, and I'm not I'm not discarding that or basically ignoring it. I'm just saying, look, there's a possibility that growth impulses flip. We get a risk off regime, but it doesn't end up in risk off. It ends up in slowdown, meaning we see this accelerate this hard deceleration in impulses, and then we see a moderate reacceleration after we're out of risk off, and that would put you in the slowdown regime, which is still bullish Bitcoin and defensive sectors. And we've kind of been seeing that actually in a weird way coming to fruition. Like if you look at XLV, like XLV has been doing good lately. XLU, like there are defensive sectors which are showing signs of resilience, like that they're moving in ways that maybe they shouldn't if the market was in a full-blown risk on environment. Like capital should not be going into these sectors the way it's been like look at utilities for months, it does not, they do nothing, and then just all of a sudden they end of September they start breaking out to new highs. So it's one of those things where having a little or I should say well rounding your approach is probably a good idea in an environment where, again, GDP is at the higher end of its recent range. Could it go higher? Absolutely. But could it also get softer? Yeah, it can, at least for a quarter or so.
Well,
And
funny
being
thing,
positioned,
like our system predicted the top in GDP now last time we went risk off. So I wonder
and then
if
the
it's going
market
to do
fell
it again.
20%. Yeah.
Yeah,
And
I
the
wonder
market
if
fell
it'll do that
20%.
again. That'll be cool.
Yeah. That would be cool. But at the same time, I think it's also important that you guys understand that this is not like a stock market indicator, the system, right? The system isn't just like like it's not the S&P. This is not built off the S&P, the Nasdaq, etc., right? As you can see, the system growth impulses have gotten significantly weaker over the last, call it, month. Yet the market pretty much went straight up. So obviously the value in the tool is that it's not correlated to the market. Because if it was correlated to the market, you would essentially have a one for like it would just be a symmetrical signal for what the market's doing. You have no edge. You want non-correlated leading indicators, right? And you want the ability to be able to see shifts in risk before they show up in the market. And that's what this is telling you. This is telling you that the odds of risk shifting are high. It's not telling you that, buy puts we're going to break down or it's going to be over. I think you need to have a bit of a dynamic approach here, given, there's also no economic data coming out. And that's another thing. Like how that data comes out, like, Artie, do we know? Are they going to just dump that data on us on like a couple weeks when they open up? Or how are we going to get that data?
I don't think so. I think they just kind of shift their schedule a little bit. And like I mean they're not surveying, like they're not doing anything that they normally do. So we're actually just going to be missing some data for the periods that the government is closed.
Yeah, it sounds like a mess. So it sounds like they're probably these are things that can be bullish, right? And you can argue that the market's been able to rally the last month no problem because there has been there's no headlines. Like there's no data. The market's just going to price in privately what it believes, and that's still functional. It's still fine, right? But the data points that we're missing, they may not be so. Each one of them may not be so significant. But the idea here is that the longer this goes on, the more I think of a window of possibility of shocking the market widens, right?
Yeah,
Now, I'm
like
not
as
saying like,
like market expectations start to detract from reality because we don't know what reality is. We don't have the source of truth.
yeah, now some people will say like the private sector is, good enough at making estimates and running their models, right? Like a good example is, we still get ADP, right? So the question here is, and other non-public indicators are circulated as well for employment. So the market has some idea of what's going on, but I don't know if it's so much of like the market not knowing exactly what's going on via the government data, which gets, obviously there's revisions there as well. I think it's more of like expectations kind of drift because there's just no rhythm. And when the data pipeline comes back online, maybe the data's fine, but the market just for some reason got too complacent and you get a little bit of a dip. Or maybe the data's phenomenal and the market rips, right? So there's a level of uncertainty that I don't think anyone can tell you. Like, here's a good example. All the data all the data that's been missed so far, if we were to release all the data tomorrow at 8:30 a.m. Eastern, what would VIX do? I'm saying NFP, two series of jobless claims, um, factory order, everything. Just one rip at 8:30. Like it would be a vol event, right? You would imagine. And I think that the whole point there is like, you have multiple series of data at this point. You have 2 weeks of jobless claims. You have NFP that's backed up. You have from some GDP components that are backed up. That I think at some point you can't ignore and say that it's not going to create volatility. It may create a short term burst of it, but like it might not be a long term issue. But there is a risk that look like we can't sit here and ignore it. We have to say like it's possible. And I think that that's where like this dynamic approach comes in because who knows what happens if we get a risk off trigger and they like let's just say the government shut down for another 20 days. What are like you're gonna have FOMC with no economic that'll be funny now, wouldn't it? Um but I mean the Fed has their own models and they expect the unemployment rate to be basically unchanged from last month. And it's possible that they're right. And this data isn't really new, but I think the lack of it is somewhat of a volatility event in the future. We'll see. All in all, there, I do think that risk assets don't look terrible. I mean, you can't really be bearish. Like it's hard to say that anything looks bearish. Like Bitcoin recovering looks fine for now. Nasdaq near all-time highs. We're still long all these things. Everything looks great, but we are getting increasingly cautious and rightfully so, because I mean, we're 3 times leveraged. So the reason we have to think the way that we do, act the way that we act, and approach the markets with such level head is because we can get hurt if we start letting emotions take us in a different direction, right? Like if we go into a risk off environment or a negative growth regime and we're sitting here saying, fiscal, they're going to run it hot. The market's going to go down 1 or 2%. They're going to say something bullish. They're going to keep it up. Very well, could very well be the case. I mean, you're seeing like constant touting of the stock market by the president almost on at least once a week at this point, right? If not daily. And I think that like there's a valid case to be made that like the administration will play defense if stocks slide, but we don't really know to what degree things will happen and at what levels. Like, it took the S&P it took Nasdaq going to 17K basically in April for them to start walking things back. So like, I'm not saying like we're going there, just again, realists, stay on path here. We're not calling for a recession or anything, but to think like if the Nasdaq falls like 1 or 2%, to think the government has the authority to just stop all drawdowns, probably not going to happen. Probably not going to. Probably an over expectation. Overly optimistic there. There can be dips. Lower vamp is 3% away. How would we feel if we go down there? And that's just a normal bull market dip. So it's good to be cautious when you're up here, especially when risk sentiment is shifting. And I think that keeping a tactical approach here is important. And I know I tweeted this earlier today, man. I think like in the next 2 or 3 weeks, if we get a risk off pivot, either the bull or the bears are going to hate us.
Oh yeah, happens every time. And then we start getting
Happens every
called
time.
perma bears, even though we've been bullish all year.
Yeah, yeah, I know. It's like you can't win in this game. You just got to kind of take the chips and stack them. And like if we get a risk off event, we're going to position accordingly, slow down accordingly to that. But you can't. I think the biggest problem here is that if in a weird way, if I had to take like a non-biased approach to the situation, the administration and the way that the sentiment has been going is almost like everyone kind of feels like the administration wants to melt the market up.
Oh
Right? You
yeah.
go on X, it's like the base expectation. It's like, okay, like they're gonna run this hot, they're gonna melt it all up. And I'm not one to always be like, oh, when everyone believes something, it's not going to happen because, my theory is for stocks to rise, more people have to be bullish on the market than non-bullish. Otherwise, the stock market doesn't go up. Right. And then if there's no bears left or not enough people are, I should say, if not enough bullish action in the market sentiment, then the market starts falling and bearish sentiment takes over, right? So you kind of need more people on one side than the other to push prices higher and vice versa to push them lower. So I'm not a big guy like and believer like that, but what I will tell you is like you are seeing some wild moves. I mean, we spoke about this a couple weeks ago. Like if you look at the Buzz ETF, like this is essentially this is like you go on X, you scroll down your feed, and you see some bro with a Robinhood screenshot plus 100, 200% for the year. He's long these stocks. They're long these stocks, whatever in this basket, right? Like I'm sure we can just take a quick look, and right away you guys will know what I'm talking about. AST, Intel, AMD, NBIS, SMCI, Hood, Tesla, Rocket Labs, HIMS, Palantir, SoFi. I mean, this goes on. You guys can see what this basket is. Now, this basket in the last month is up 20%. In the last, it's up 50% for the year, 56% for the year. Half of those gains came in the last month, surprisingly, right? So to sit here and say like people aren't euphoric, I think there's a lot of people that are up quite a bit of money, quite a large sum of money. And I should say there are a lot of people up large sums of money, but they may not be so proactive to risk signals because they're, maybe they're long calls, whatever, and they're rolling calls out, and their strategy is just perpetually roll calls. And for that to happen, you need the market to continuously drive higher, otherwise your premium isn't going to pay out. And I think that a lot of people are almost getting to this sense that like small caps are supposed to be let's look at IWM, right? After last FOMC, that they had like a really strong move, faded back, chopped sideways, tried to break out, failed again. Like you're not seeing the same power in small caps than you are in the mega caps. And this is, after confirming slowdown regime, confirming rate cutting regime and everything coming to fruition from the Fed, like odds are they're going to cut again this month. Small caps aren't really breaking out. Argument can be made that rates are probably still a little too high on the floor of the Fed policy at 3% is probably still too tight for small caps. But all in all, like these aren't ripping, but you see like this weird sector of the market, Buzz, NASDAQ, everything's ripping in these sectors, obviously. And I think it puts something in place here where like maybe the system goes risk off or slow down for like a month or two, and maybe we just get a regular dip. Like we haven't seen Momo since May.
Yeah, it's pretty wild.
Pretty
Well,
wild. I mean, like,
I'm curious. So like we're getting this growth slowdown trigger. What do you see being the cause of this? Like what do you think the problem's going to be once it becomes evident to the market?
oh, you're saying okay, like what? Like let's just say we go to
Like
risk
what's the
off. What is going to
catalyst?
be the driver? Right. Okay. So I personally think that um I don't know if it's going to be a persistent thing. Like I'm not talking about prolonged periods here, but I could see this being a problem. Like let me go back to let's take a look here at growth, right? And if we take a look at where we are right now on the output contributions, right? We know that labor has been pretty soft, or if not declining, right, in terms of contribution to output. What I mean by that is the job portion of output contribution, meaning when we measure output, we can measure the contributions of job growth, hours worked, or productivity. We know that job contributions are overstated. So most likely productivity contributions are understated. So therefore, productivity contributions to output have been higher than estimated. And we could see that by the 50% loss of the total jobs created over the last year via the revisions, right? We lost, basically jobs were overstated by 2x. And I think that the risk here is maybe all you have to do is have a slip up in productivity. If productivity is mainly driving output at this point, you run the risk of like we call it the AI, like the AI wave, which has exploded since ChatGPT came online. Productivity became massively a massive contributor to output, and you run the risk in this environment where if payrolls are slow, right, and productivity is the only thing keeping output out, If productivity slips for whatever reason, maybe it's a compute issue, maybe it's another macro issue that if it's construction related, transport related, whatever it may be, tariff related, right? And access to productivity gets crunched, and that's where all your real gains are coming from. Then you run the risk of productivity falling a little bit, but that whatever it falls will send you much further down in output. Because simply put, if we take a step back, we know that in recessions, productivity typically goes up in recessions, right? That's normal. But if productivity is staying where it's at, job growth is slower or lower, and then productivity falls and job growth goes even lower into negative territory, you run the risk of, everything's hinged on optimization and productivity, and you're trying to squeeze the juice out of in an environment where like you can't. There's a macro headwind that comes along, and that sends us into risk off. And another aspect of this is just like how hot growth has been. Like we know that growth has been just really strong the last couple of like last quarter or two, like going on third quarter here, it's looking good. Quarter two was good. Quarter three is looking good. Like it's possible we see some sort of slowdown into quarter four. Now, if maybe we see an acceleration, but as of right now, our system is saying be cautious. So I think that this whole risk off pivot, if we do get one, is probably expectations that going back to our productivity section, right? A way to simplify this is probably saying that productivity enhancements can outpace job losses, right? That's what the market's been betting on. Productivity enhancements are outpacing the negative effects of lower job contributions. And if that doesn't end up being the case, then I think you have a market that was overly optimistic on the idea of labor is irrelevant, payrolls don't matter because productivity is strong. And if productivity weakens and job contributions also weaken further, then you have the perfect setup where the market's almost shrugging off weakness and then it becomes problematic. And that's, I think, the risk here. I don't know if it's likely yet. We're still in risk on and markets still look okay. But if I had to just be devil's advocate here and say where we are right now, I think that's probably what I would be concerned about.
Yeah. Yeah, I definitely see that as well. Like the job market has not been looking good. Like we're literally just floating on productivity. So,
Yeah,
like I eventually that's going to start causing problems.
I know. And like the question is how long can you crank out, productivity contributions? Like I think the base case that everyone has gotten confused up until this point is saying that like AI has no positive economic effect. I think that's the problem. AI does have a positive economic effect. It increases productivity. Literally, what ChatGPT came out what in quarter four, 2022, right? And all of a sudden, productivity starts dominating, and obviously not just ChatGPT, but AI revolution as a whole. Like there's some influence here. To ignore it's crazy. Now, I do think that the realist approach here, right? The more balanced view is like AI is makes job growth irrelevant up until a certain point. And I think that point at which AI made like the introduction of AI lowered that barrier of where job growth or contributions or however you want to put it, payroll additions can go, that and immigration, and productivity can eat up some of that loss. But at some point, let's go back, right? Let's go back to last 5 years. In 2020, you had productivity adding 5% to, or in the third quarter of 2020, you had it adding 6%. But jobs contribution was negative 6%. Obviously, this is the pandemic, a bit overstated. But the point here was like productivity was super strong, but it couldn't offset job loss contributions. So at some point, I don't think AI can offset emerging like the lack of emerging businesses because AI by itself, it's not sentient, right? To the point where like it can't make its own business, sell its own goods, service its own sector. We need people, we need industry, we need, if it's AI is only a layer on top of a business, it's not a whole business. It doesn't create a whole business, right? So without active and persistent job, at least growth to the point where you're not taking away from the economy and there's positive output, As long as that's the case, AI productivity is going to be a driving factor for growth. But until it's no longer the case in the sense that it falls negative, then you're going to have a problem. AI can't save everything because AI, the deflation that everyone's talking about AI being, that deflationary tech, it's going to kick everyone's job. It's not there yet. Like AI is not, it's good. It's a productivity enhancer, but it's not a multi sector business replacement. Like it's not taking out a multi-industry replacement. It's not eliminating industries, right? It's a tool. It's not really a business right now. And I think that as long as that's the case, you do have some sensitivity to the labor market.
Yeah.
There is risk there, you know? All right. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar or go to our website at market-radar.com.
We're going to be doing a Q&A in the Discord. So the stream's going to end, but if you guys want to ask us any questions, join the Discord, ask us some questions.